This episode of Masters of the Market is proudly brought to you by AIA Health Insurance with AIA Vitality, cover that protects and rewards. To find out more, call 133 AIA or visit aiahealth.com.au today.
Look, to buy when there's blood in the streets. Lift up, check under the carpet. Many try, but few become master of the market.
Well, Matt Haupt, thanks very much for coming on Masters of the Market. Really appreciate your time. I thought we could start by introducing WAM Leaders and maybe Wilson Asset Management more broadly, and what the company does and what you specialise in there.
Yeah, WAM Leaders is an ASX 200 focused listed investment company. So we have a bottom-up approach with a macro overlay. So we use a combination of the two techniques to position our portfolio. Wilson Asset Management been around for a long time now, over 20 years, and we run listed investment companies. So we've got ranging from micro caps to the mid-small caps to what I run as the large caps, and then we've got the global fund and a recent addition, the alternative assets fund. So got a wide mix at the moment.
And you're renowned in the industry for your thoughts on macroeconomics, and considering that's what I spend most of my time thinking about, I really wanted to dive deep into that and some of the big macro issues facing the world. And I thought a good place to start would be US interest rates and bond yields more broadly. Can you see a future or foreseeable future where US bond yields increase?
Yeah, I can, Chris. It's an interesting topic. I guess we'll check in. The first point to check in is around Jackson Hole. So clear messaging for the first time from the Fed about their position on nominal rates. Basically, Powell said the damage done by lowering the nominal rates further from here has profound consequences. So for me, that was a line in the sand that nominals won't change unless you get a severe shock. What will change is real interest rates. Obviously, they want to let inflation run. But the Fed tools, they can't really promote inflation. What they can do is have accommodative policy, but it's really fiscal which needs to run in the background to get inflation. But I guess the key thing is inflation does come through fiscal, the Fed won't be moving that short end rate.
Yeah.
And I mean, that's key. So the trade at the short end has been the long duration equity tech plays. So I think that will still remain the case, but I think the long end is where you're going to see the action, because the short end is nailed down. They're not going to move it. You won't get a big rise in the short end, but the long end is where all the action will be, and that has some big consequences for different sectors in the economy.
So for them to say they want to drop the nominal yield even further is almost really saying they're going to go negative, isn't it? Because there's nowhere really else for it to go from here.
Yeah, correct. And I think the key thing I took out from Jackson Hole's speech was he was saying the damage done by lowering the nominal further far outweighs the benefits. So that was a clear line in the sand that the nominal will not move unless there's a severe shock or some other unforeseen circumstances. So that was a clear line in the sand. The damage done will be greater than the benefit.
And so he also said during that time, Chairman Powell, that he wasn't going to introduce yield curve control. And there's no real need to introduce yield curve control in the States because there's no inflation. What he did say is they were going to let inflation run above their previous 2% target for an extended period due to the deflationary environment we've had. You mentioned that he can't create inflation, but he has done some things differently to what Bernanke did post-GFC, certainly buying corporate debt is something that some believed wasn't even legal, and certainly something Bernanke didn't venture into. Do you think that's important to create inflation, and do you differentiate that from just buying government bonds?
Yeah, I think inflation really will get down to business activity and closing the output gap. So I think at the moment there's a huge output gap with the economy. So we're nowhere near where we need to be for inflation to come through. So we need that output gap to close. What I think will be key for inflation is once we get the fractional banking system going, because at the moment loan growth and the velocity of money is really low. So once the fractional banking system kicks in, all those excess reserves, that's when you'll start seeing increased credit growth and lending, and then you'll get the inflation coming through once we get that fractional banking system lending money.
We've seen him, Chairman Powell, really encourage fiscal spending. He's basically said we've almost done as much as we can in terms of stimulating this economy. People say we don't have MMT yet. There's not sort of an explicit guarantee given by the Federal Reserve to the Treasury. You spend as much as you want and we'll cover the deficits in perpetuity. How far away are we from having a more official type MMT introduced where all of a sudden deficits seemingly don't matter?
Yeah, I think we're very close. It's really going to get over the next 3 to 6 months the direction we take. If the economy doesn't get back to normality or close to it, we'll really have to see some, like the fiscal impulse that's needed to create the economy or get it going. It's a huge amount of money that needs to be put in place. So if that keeps going in that direction, then the Fed will have to monetize that debt, because there's just no way you could be running deficits like that. The flow-on effects are huge, and it's just not tenable. So the Fed will have to step in and start to monetize that, which I don't think is that big a deal to get through this or navigate through this period. But yeah, it's definitely on the cards in the next 3 to 6 months if the economy cannot get back to some level of normality.
The thing that makes me nervous is you've got US elections coming up. Maybe not nervous is the right word. I think if you get Democrats control both the House and the Senate, I think the fiscal stimulus is going to be huge. There'll be trillions of dollars worth of new green projects, and they've already announced some of their plans. If the Republicans control both, I think the spending will be huge. If Trump wins and the Democrats control the Senate, again, I think the spending will be astronomical. The only combo where I think you could get a level of fiscal austerity is if Biden were to win, but the Republicans control the Senate, which is really what we saw in the Obama years and the Tea Party movement. Is that something you're watching, and could that change how you're viewing the potential reflation environment in the US and around the world?
Yeah, 100%. You're right there, Chris. Like you look at what happened during the Obama period. Like anytime there was, the fiscal cliff would come up or the deficit rollover of debt, there was always a fight to the death. That extend it, and then the last minute get a deal across. And just every move they made was stopped right at the death. And the stimulus, the infrastructure, they had the infrastructure plans which were knocked back repeatedly. So that would be the worst case scenario. It's quite interesting going into the federal election now. You look at the US election, you look at the volatility curves going up there. You think, like, this market's starting to get a bit shaky now, but the vol going into the election, it just feels like some of these scenarios are starting to be played out in people's opinions on how we go. But definitely the scenario you painted there would be the worst case scenario. Obviously, the reflation trade would be great around the Democrats because they are big spenders. So for us, we'd be very well positioned if that would happen. But I think Republicans will come to the party eventually. The biggest concern I have right at the moment is the short term getting the CARES package through. It's just dragged on forever. And I think if we can get that through, it really buys us some time. So it will take some of that vol out going into the election as well. So hopefully we can get a CARES package through in the short term to fix some of that those issues going into the election. Because if we don't get that sorted, you got the vol, it's just going to run out of steam. And then some of these scenarios you're painting now will be factored into some of the bear cases. And that'd be horrendous for the reflation trade. And then you'd have to start thinking, do you go back to these tech long duration plays? Because rates won't be moving for, it could be like 5-7 years. You just don't know. So that would be the worst case.
So let's say we get one of those three combinations in the US election where we feel inflation is going to come due to the enormous fiscal spending combined with really loose monetary policy. US can't afford higher rates due to the amount of debt the government has. Do you think they introduce yield curve control once that happens over there in the US, if inflation is such that bond yields should be increasing?
Yeah, it'll be interesting to watch. I mean, in the belly of the yield curve at the moment, there's no need for yield curve control because rates are obviously not moving. People's expectations are for rates to not move for 3 to 5 years, basically. So there is no use for yield curve control, but it's definitely something they've tabled, and it's quite interesting to see. Like, if we start to get some of the yield curve, like, we're going to at least get to see the appetite of the Fed on how far they'll let the yield curve go if it does go up. So that'll be a real testing point, because if they start introducing yield curve control, I mean, again, we've seen it in Australia, it just destroys the financial sector. So the financial sector is already pretty wrecked in the US as well, massive underperformer, but yield curve control on top of that is just another negative headwind. So from what I've gathered from all the Fed speakers, is yield curve control not on the table at the moment, but there is no need for it. So it's a silly discussion. It's not needed. But yeah, once the yield curve does start moving, yeah, that first sign of them interfering will be a key way to position your portfolio, because it dictates so many things.
And if it does come in, do you effectively lose the US bond market as an asset if you lose that element of price discovery?
Yeah, it's interesting. Like, with bonds at the moment, like, people are saying they're not really an alternative anyway. So, yeah, if you get more intervention, well, what's the correlations are all sort of mixed up at the moment as well. Is it defensive, or you just don't know? Like, yeah, I think the correlation, because of where rates are, has fallen apart. So bonds have seemed to lost their place at the moment. But it'll be interesting to see. At the moment, we don't have the answers, but I think as yield curve and rates go up, it'll be interesting to see the flows into bonds, whether money does go back there from equities. But it'll be a really interesting dynamic. But you would have thought, if rates start moving, economic conditions start improving. So it'll be a fine line between money going back into equities or switching to bonds. But at the moment, it just feels like equities are the only solution for most people at the moment, and I think it will stay that way until we get to around 1% on the 10-year, or 1.25 if we actually get back there. It feels like a long way off, but if we get around there, that'll be a real testing point, I think, on allocations.
You mentioned big tech before and how highly correlated that's been with bond prices, and inversely correlated to bond yields, if you like. You know, there's been some talk that for some investors, those big tech plays have almost replaced the bond market. They're super safe, you know, in some ways safer than governments and what we're seeing by different governments around the world. With such low yields, you can forecast any growth becomes highly attractive. Do you think it's possible we could live in a world where those ultra mega cap tech stocks do replace government bonds in part as an asset class?
I think it's happening, and like, I wouldn't really agree with it, but the behaviour is there, because you see, like, with the federal programs in the US with Apple, you know, the Fed buying debt issued by Apple and the like. So people are saying, well, the Fed have got the back of these companies. They've got a yield higher than a bond. Rates are low. The Fed are intervening on credit spreads, so credit spreads are compressed. I mean, they shouldn't be anywhere near where they should be at the moment. So the alternative is a bond paying, you know, at the short end, you're getting 25, 30 bips maybe, and then in the mid to long end, you're getting 65, 70 bips. Why wouldn't you be invested in some of these equities? I get that rationale. It's not something we do, but the rationale is pretty sound at this point in time, especially if you've got a view that rates aren't moving for 3 to 5 years. And I think that's probably the right scenario for the Fed. You probably won't see a move for, you know, at least 2 to 3 years.
And gold's the other asset class that gets spoken about to replace some of the bond market if investors lose appetite to invest there. How do you see gold performing in the next 3 to 5 years, given the macro context we're looking at?
Yeah, I mean, you paint every scenario for gold and it looks pretty positive. 2018, we really started going heavy in gold. And when I look at gold, you got to look at the positioning as well. So you look at the CFTC positioning, which is the speculative or the futures positioning on commodities. And in 2018, very much underbought. It was very much underbought. So now it's very much overbought. But the conditions there, I'm trying to paint what could be negative for gold at the moment. You've got, Fed hoping to run for high inflation. That's a tick for gold. You got low nominal rates, high inflation, low nominals equals higher negative reals. I'm trying to paint a negative picture for gold because I hate being on the momentum trade or being on the consensus trade, but it's hard to say why will gold go down from here. And the fiscal position of countries is getting worse. The US fiscal position, so a weaker US dollar potentially could be playing out for a longer period of time too if rest of the world picks up. So it does feel like gold is very much consensus, but I'm finding it really hard to paint a negative case for it. So we're still maintaining our gold position. And I think over the next few years, gold looks okay. I thought there might be some short-term weakness in gold or consolidation around if you get a pickup in yield curve, whether gold becomes a funding source and people move into other asset classes. Still debating that. I'm not sure whether it will happen. It sort of felt like it's trying to consolidate around here at this point in time. You've had a few liquidation events when you get a big sell-off. Gold often becomes a funding source when you get a big sell-off in a risk event, but then bounces back. So we're consolidating around these levels, around 1900 to 1950. But yeah, over the next couple of years, it just feels like gold's in a very sweet spot, and it'll be hard to disrupt it at this point in time.
And we know political uncertainty is a tailwind for gold as well. How the world's currently looking, certainly China relations with the US and Australia as well have been very much in the headlines of late. How are you feeling about trade relations with China, both from an Australia and US perspective? And maybe what do you think globalization 2.0 looks like in that context?
Yeah, so I'll touch on Australia first. I'm very nervous with our relations. We seem to be going down a collision course, and it's just been escalating. Recently, there's been a bit of a paring back on the Australian side, so I think they've got the message. But I really think for Australia, with such an important trading partner, I get the political stance, but there also have to be some sort of realization around in the new world, China is going to be a louder voice. We don't agree with some of the things China does, like as a country, I guess, but the same could be said about the US as well. Like they've had a clouded past as well, and intervention across the globe with various policies and military intervention. So the same could be said. There's always a collision course when you've got global powers, a change of global power. So it's a collision course that will be stuck on for a period. But Australia, I'm not sure whether our stance is the correct one in the short term. It should be more out of respect, I think, how we deal with China. So I think in the short term, some of the companies under threat in Australia, we've seen them. They've gone out after our agricultural sector, which is an easy target because you can replace that basically with any other substitution across the world.
So Treasury Wines was a big one that got hurt recently in that space, didn't they?
Yeah, they got really hurt through investigation around whether it was sort of like an anti-dumping case, which is I'm not sure if you could call Grange dumping. Maybe their lower stuff maybe fair, but we'll see how it progresses. But
if they are going to dump Grange anyway, I prefer they dumped it in Australia, to be honest. And,
happy to take a few. Yeah.
What about some of the milk players, A2 Milk, Bellamy, some of these companies that have been huge benefactors of relations with China? Are you nervous about the outlook for these companies that are really exposed if the landscape changes?
Well, I think New Zealand for A2 have been a bit, they haven't been as aggressive as Australia. So New Zealand companies are probably okay.
Yeah.
Bellamy's obviously got a relationship, so they'll be okay. The ones I'm concerned about are our mining companies, but they're such a big proportion of their imports to China that it'd be very silly of them to go after them at this point in time. So I know Fortescue are a great ambassador, I think, for Australia. Their engagement with China is great, and they've got China involvement in the share register, so I think they're okay. But yeah, I just worry about some of the damage that can be caused purely from a financial impact for some of the stocks we own as well. So it's a strange policy path to go down for Australia. I just don't think there's much benefit at this point.
Talk to me about China's debt situation. They've got huge debt in their both public level and the private banking system. Are you concerned about the level of debt in the Chinese economy?
Yeah, I think the thing with China debt is it won't be a concern until it's a concern, and I think it's been a concern for 15 years as the huge amounts of infrastructure have been built and local government bonds, and they tried socialising a little bit of it over the last few years, and I think that will continue. So whenever big banks get in trouble, they bail them out effectively. They bail out bondholders. They're letting a few go bankrupt now, but it's still very much intervened. I guess in a closed system, you can do that. If the Chinese economy opens up more, market forces will dictate more of the outcomes of these companies, and obviously that'll be a negative. But I think in a closed economy and with high levels of personal saving, the overall mix isn't that bad, but it's something we watch the non-performing loans and some of the issuances on bonds. But so far, so good. They're really going hard this year on the local government bonds. I think it was in July in the total social financing stats, the local government bond issuance was the largest ever. So I think it was running at 1.4 trillion for the month. So they're really spending a lot of money on infrastructure and at the local government level to prop up their economy. But at the moment, not an immediate threat, but longer term, it's obviously a concern, the amount of debt they're running. We just hope they don't turn into like a Japan later on where they just get surrounded by all this debt and just can't work their way out of it.
And a lot of their debt is in US dollars. Do you subscribe to the fact that, well, they're short US dollars more so than what some believe? And do you also think that was in any way related to their desire to take over Hong Kong and gain access to some of the US dollars in the banking system there?
Yeah, I've read a little bit about it, and there's a few conspiracy theorists out there saying, yeah, they were short US dollars and Hong Kong was just a play on that. I think they're okay at the moment. Obviously, they've been trying to move away from the energy as well, paying in US dollars. It's not really a viable situation for them at the moment to run the yuan as a reserve currency as such, or get away from the US dollar. But I've noticed they've been a big seller of bonds in the US. So they've moved the dial a fair bit there. So maybe there is some truth to the aspects of short US dollar. But you would have seen when the crash happened in March, the US swap lines that were opened up globally. And that was really an alliance, I guess, to all the supporters of the US, allowing them US dollars, whereas the other guys were caught short. So that was a real defining moment. Whoever was on that swap line list, that they were a friend of America and they were allowed to use the Fed to get access to US dollars. And a lot of countries were left out, and China, of course, is one of them. And the US have been continually trying to ratchet down their ability to get access to Fed discount windows. And even with like HSBC now, the move to Hong Kong, they're trying to stop that happening as well. So it's really a game that's just going to continue for the next, probably the rest of our lives, really, the battle between US and China.
And China are now pricing oil contracts in yuan and purchasing oil in yuan. Is that material and something that you feel is significant?
I don't think it's material, but it does have broader consequences, I guess. But I don't think in the short term it's material because there's not too many people that want yuan.
Yeah.
So it's all very well and good to start writing those contracts, but you need counterparties. And at the moment, I don't know who would be wanting to be long yuan when the currency is probably not freely floating. So they can do whatever they want with the price of the currency, really. So I I think the US dollar. I think the death of the US dollar has been called about 50 times over the past 30 years as a reserve, and at the moment, it's still the most dominant currency. Won't be replaced. The yuan won't replace it because you need counterparties that believe in the issuance of that currency.
Do you think, though, if you do have central banks intervening in bond markets all around the world, I know we've sort of focused on US bond market, but we've already got yield curve control in Australia and we've got it in Japan. So it's something that's not just theoretical. It is already happening in parts around the world. If that happens and you lose that price discovery, do you think you'll get more volatility in currency markets? Is that where the price discovery will effectively come out if it's not coming out in the bond market?
Yeah, I think you're right because you see the volatility in the bond markets are non-existent now. So we look at the MOVE index, and there's no volatility in bond markets, but the FX markets, it feels like the spillover of vol has rolled over into the FX markets. So FX markets, I guess, when nominals aren't moving, that price discovery lever falls apart. So it's really FX is really hard to trade at the moment. It's really around the risk on, risk off trade. So US dollars, the risk off trade, like that always gets bid in a risk off environment, and the risk on trades like Australia currency is obviously bid higher on a risk on trade. So it feels like the bond market vol has spilled over to the FX market, and we're getting all the variability in FX at the moment. So I think you're right there. You'd expect to see more vol in the FX market going forward, and we've seen it over the last 3 months. It's been huge moves. Intraday, short-term trends, long-term trends. There's been huge moves.
And US dollar or short US dollar, long Aussie equities really feels like it's one and the same trade. Do you think it's possible there's a world where the US dollar goes up and Aussie equities drop?
Yeah, that's an interesting one. Like the correlation with the Aussie.
Sorry, where US dollar goes up and Aussie equities go up. Do you think that's possible that can happen?
Yeah, I was just going to say the correlation on the Aussie dollar used to be related to the S&P 500 volatility. When volatility fell, Aussie dollar would go up. So it's sort of similarly related to the market as well. But I think definitely if the US dollar goes up, then we need to work out why it's going up. If it was going up on a bid for safety or a flight to safety, then the Aussie market probably be going down. It feels like more like the US dollar should be falling for the Aussie market to go up, but to have the US dollar going up at the same time, I'm not sure how that would play out at this point.
It's so deflationary if the US dollar strengthens, isn't it? You can't see the reflation trade happening, especially when you combine the other deflationary factors that are already alive in the macro environment, aging demographics, tech, lack of velocity of money. It sort of feels like that's one and the same trade.
Yeah, it does. Like it just feels like from here, economic recovery will see rest of world pick up, and then the rest of world currency should outperform the US dollar. Because obviously during the pandemic, the crash, the flight to safety was dramatic. You saw the US dollar bid. I mean, even the Aussie US cross. I mean, the Aussie got decimated, but has rebounded quite strongly. So I think if this recovery takes hold, it's hard to see the US dollar outperforming. If the US dollar is outperforming, then I'd say that's a negative for equity markets in the short term. But I mean, the short US dollar trade seems to be so consensus. So again, that makes me worry about the positioning. So it's very much a consensus trade at the moment, short US dollar.
And do you view it, if the US dollar is increasing in value with so much debt around the world priced in US dollars, and if rates aren't going up, if the US dollar is increasing in value, that level of debt held by businesses all around the world is increasing, effectively having the same sort of painful outcome.
Yeah, I mean, that's massive negative for emerging markets. So a lot of the emerging markets have huge US dollar debt loads. So if US dollar is going up, really bad for emerging markets. And Australia gets thrown into that basket sometimes too, because again, our currency is really linked to emerging market currencies. in that scenario, you can see a negative for Australia.
And talk to me about energy markets. How are you feeling about them? They're obviously going to be integral to a reflation trade if that comes to bear. How are you viewing energy markets around the world?
Yeah, energy is an interesting one. Well, obviously, we've had the rebound from the spike down. It's really around demand coming back. So we lost around 15 million barrels of demand through the pandemic. OPEC have cut around 10.5 million barrels. They've got to meet later this month in September. I really don't know how they come to agreements in OPEC meetings with all the characters in the room, but like somehow they do that. It's like watching a soap opera. I'll often stop and watch all the bloggers coming out of the meetings, and they won't reach a deal. Then the Russians and CIAs we're going to have a meeting, and then they come out and said, "Oh, we've reached a deal," and they haven't told other people, but somehow they get through it. But
they reach a deal, they just don't often stick to what they
exactly
stick to what they said they were going to do. Post.
Well, you get a deal, and then no one complies, so you just work out what sort of compliance you're going to get. So it's a really tough trade. But the fundamentals are in place for a really bullish medium-term outlook for energy. You've got US shale, which is going to be dropping maybe 4 million barrels a day from its peak to maybe 5 million barrels a day. The OPEX or CapEx from businesses in oil are cutting, 35, 40%. So all the dynamics are really favourable medium term. Short term, there may be some noise around OPEC compliance and OPEC meetings if it falls apart. If OPEC plus falls apart, that'd be horrendous in the short term. But if they can maintain it for the next 6 to 9 months and we get that demand coming back, I think everything's set up for a really bullish energy scenario. And I think being long oil into that will be a very good trade. We just got to go through all this noise period at the moment. But I think everything looks good about it medium term.
So that's medium term. What about if we try and forecast longer term? You've got prices of commodities are created by the marginal buyer, if you like. There may be a world where that marginal buyer is no longer buying oil, particularly for cars as they move to electrification. But then you've also got the idea that, say, cigarette companies became a good investment, not condoning cigarettes, but they finally became a good investment when there was a ban put on advertising, because all of a sudden they just became cash flow assets. They stopped spending on advertising to try and acquire new customers. And that could correlate to oil companies that no longer spend on exploration, just really become cash flow assets. Out of those two different arguments, in the longer term, which one do you more align with?
I still think there'll be demand growth in oil. I know BP just called the end of demand growth this week. That's generally a good sign for oil because these big companies normally make horrendous calls at the inflection point. So I think that's a positive that they came out and said demand growth. But even if we get to your scenario of like a usage or demand fall over the years, that downside case goes very much to what you're talking about with the cigarette companies, where they become cash cows, huge yields. No one's replacing the supply of oil, and the incremental cost of a barrel just goes up and up and up, and they become a great business to own and just a huge dividend yielder. So for us, I'm not sure which path we go down. I would have thought we go down the demand growth path because, again, we've seen peak oil, I don't know how many times in my career as well. And we keep having demand growth year on year, barring pandemics and GFCs. But the demand growth, obviously there's a new one coming with the electrification of vehicles, which is a bit of a headwind. But again, we're talking maybe 2030 before that really becomes kicking in. And with the CapEx reductions over the next few years, I just think the medium-term environment is great for oil.
And it's also using a lot more products than maybe what some people realise, isn't it? From fertilisers to plastics to air transport. It's not just, internal combustion engines is just one part of the demand story.
Yeah, correct. I think it's, from memory, it's around 14% of global oil usage is cars. And our aviation's around 10%. So you're right, there is a lot more use of petrochemical industry than meets the eye to most people.
Brilliant. So most of our guests come on. We finished with 3 questions. So I wanted to. First one of them is what was your first ever investment?
Oh, the first ever. This is embarrassing. This was back in the tech boom. It was Davnet, a company. So
There you go.
yeah, so they had a few satellite dishes on top of buildings. And it was a new way to connect, revolutionise connections between businesses. And I think I was buying it around 40 cents, and I think it went up to $4, something $4.40. And then being very young, I thought I was a genius. How easy is this game? Then kept buying all the way up, and then had my highest position near the top. And then I got wiped out in maybe a couple of weeks, I think it was. But yeah, I was investing back in the tech boom back in 99, 2000 was around
You
then.
in uni then?
This was pre-uni.
Pre-uni. Yeah, I reckon I've spoken to about 4 or 5 people who were in uni in the late 90s, and you're about the fifth person who's mentioned Davnet. So
Oh, really?
it must have been a red hot stock.
Oh, it was a great one there. It's just a license to print money.
And what advice would you have to your 18-year-old self about investing or otherwise?
Yeah, I guess the advice is do your own research, and like always be curious and try and find not the truth of information, but just surround yourself with people that have independent thought process and you can chat through ideas with. Because I think when you're young, I know about yourself, but I'd read a broker report, with a buy recommendation. I'd be like, oh, wow, I must buy this stock. But you really got to go to the source of the information, find your own truth, and really stick to a process. Whatever your process is, you can make money various different ways. Just have a process, be disciplined, and when things change your view. Don't just sit there and hope it's not an investment strategy.
Brilliant advice. And what's the most common mistake you see retail investors make?
It's momentum as well. So getting caught up in the hype. We saw it now, just recently with the NASDAQ style stocks. And we're seeing it now with the buy now, pay later stocks, all, going up 500, 800%. I just think, you get caught up in the momentum and the emotions kick in. And one thing you don't want in investing is emotion. You try and be as little as emotion as possible. Just try and be as rational as possible. And when you're finding yourself getting caught up in the emotion, that's generally a good time to exit. And the same when the market fell in a hole in March, because I've been around for a little bit, you just know that's the time to buy when everyone's like, oh, the world's going to end. All these companies are like trading below net tangible asset backing. That's the moment you buy. You don't sell.
Brilliant advice, Matt. I've loved it. I've loved chewing your ear off about macro. I could do it for a lot longer, but you've got a real job to go to. So, mate, thanks very much for coming on and really enjoyed the chat.
Thanks, Chris. Appreciate it.
Thanks, mate. For more info on today's partner, AIA Health Insurance, visit aiahealth.com.au or call 133 AIA today.
If you're enjoying Masters of the Market, make sure you subscribe to Chris Judd Invest.